Over the last 20 months, Vertiv has almost tripled in value. Is this company worth that much? That's what I want to answer on this video. It's really interesting that the AI energy is really pumping up certain stocks. The expectation that data centers are going to be built out completely, they're going to add more data centers online in order to support the AI push. And although I think AI is a super interesting topic, I think it's going places. I'm just not completely sold that all IT investments from corporate America are going to be dedicated to AI. I'm just not completely sold on that. Therefore, I'm really questioning the valuation of Vertiv. I think it's great for especially smaller businesses to really see a lot of interest in their stock. But this one here really stuck out. And one of my friends, Scott, with Scott's Due Diligence, he actually came across this company on a live stream, and I noted it and thought to do additional research on the company and form my own thesis on the company and share with you what I plan to do with this particular stock. Now, I'm going to look at the company. I'm going to go through my valuation process and then share that with you. At any point, this is never a financial advice. I'm an individual investor just sharing my journey, sharing my experience, my ideas, and I hope you find them interesting. But I don't recommend you buy Vertiv stock. I don't recommend you sell it. I don't recommend you short it. I don't recommend you buy options on this stock. While I'm at it, let me tell you about a sponsor I have on my channel. Mumu has been generous enough to sponsor my channel. I really appreciate that. They have a new offer for new account holders of Mumu where they'll pay you 8.1% on your cash for 3 months. And then after that, 5.1. It's great to say that, hey, you can make 8% on your cash. Isn't that awesome? And you can also get 15 free stocks if you deposit $1,000 or more with Mumu. So take a look at that offer. It's in the detailed descriptions of the video. If you're interested and if it's the right thing for you, take a look at it. Now back to the video. So who is Vertiv? What do they do and why do they participate in the economy? So Vertiv really creates hardware for the data center, and they do simple things like cabinets for server racks, but they do cooling, which is really important for artificial intelligence based supercomputers, accelerated computing. These GPUs create tremendous energy, tremendous heat, and you need to control that heat or else you're going to have other problems like fires or components failing because they melt. So their cooling systems are really important as you build out data centers. Now, I think it's interesting. I think they're really taking advantage of a current trend of the data center being updated with accelerated computing, which is great. But I would say that this is hardware, and the industry itself is not an industry that I think is very profitable and therefore very valuable. When we look at technology, the ecosystem of technology, hardware companies tend to really battle it out with other competitors. It becomes a commodity. And then they have lower margins because they have to compete against other players. And as you can see, this company also, they have a tangible product where they're producing a piece of hardware, materials, manufacturing, distribution, all those are expense items. Very different than actually a software company where they don't produce anything tangibly. There's no inventory in a software company, but Vertiv carries inventory. So all those things matter to me. When I look at a company, I'm looking to see, does that company have competitive advantage? Do they have a moat, a barrier of entry into their industry? And those are really important because if you look at the most valuable companies in the world, they tend to have really strong moats, really strong barriers of competitors coming in. To give you a quick example, Alphabet has Google search, and most of the people on the face of this earth use Google search. So they control 90 some percent of search, especially in the US, and therefore can really command great advertising revenues from advertisers. That's a very strong moat. Is somebody going to replace Alphabet's Google search soon? I don't think so. I think it's going to take uh, really a lot of innovation and time. So that moat and that competitive advantage is really protected for Alphabet. Vertiv doesn't have anything like that. They do cooling systems, which is likely super valuable for a data center, but they could be easily replaced by a competitor. Or better yet, what if one of the hardware companies, one of the bigger ones, let's say a Dell, let's say a Hewlett Packard Enterprise, they say, we want to grow our product portfolio, let's do cooling systems. And they start competing with Vertiv. That's most definitely a threat. So when it comes to the value of the business, I don't think of the business as a very highly valuable business. The moat isn't very good. The competitive advantages aren't very strong. And the barriers of entry to other competitors aren't very strong as well. That said, I'm going to classify it as a low value industry, low value company, and value it accordingly. The other thing I want to look at is risk. Is this company in a segment where I view it as highly risky? And in the case of Vertiv, the answer is yes. And as we look at a company that's seen its stock price really fly off the charts, that's why they're risky to me. When you see a stock rise 288% over the last couple of years, geez, when's it going to settle down and come down, 25, 50%? That's the risk that I'm pointing to. So to me, that's a factor in looking at the company and seeing if I really like the business, if I really think, boy, this business, it's going to go places. It's going to be twice as big from a revenue standpoint over the next couple of years and so forth. I don't feel that way about Vertiv. So the business is just a hardware company. They have a niche within hardware, which is cooling, which is, I think, very desirable, very in demand right now. But is that sustainable for the next 5 years? I don't think so. Let's look at the fundamentals now of Vertiv. So Vertiv, the stock has just really gone up. If you look at the last 5 years, the stock is up 789%. Holy smokes. And if we really narrow it down and just go back, let's say about a year, the stock is up 644%. That's incredible. But is it too incredible to believe? That's a question that I'll keep open until the end of this video. This is why this stock really caught my attention. Currently in the market, I believe, especially in technology around that data center, it's impossible to find a discounted stock, but it's quite easy to find stocks that are highly overpriced potentially. And this is one stock that I thought, this stock might be really overpriced and really a good short position candidate. Looking at the fundamentals of Vertiv. So the company has a market cap of just about $34 billion. So it's not too big of a market cap. And the company revenue is about 7 billion. This is a hardware company, and hardware companies tend to have a low, price to sales ratio because it's hardware. The company has a PE ratio of a whopping 87. Holy smokes. Now it's expected that they're going to have a forward PE of 36. Historically, PEs for hardware companies, I view them as between 12 being an average hardware company that's showing modest growth, profitability, and up to 18% for probably one of the better hardware companies. But reaching for 36 is a forward PE that probably has a pretty ambitious, optimistic view of the company, is a little too expensive. The dividend, really, there is no dividend, 0.11%. There's a lot of analysts and they're saying, buy it, man. The AI hype is strong and buy it, but it's, being priced at a premium, and it has had a recent pullback, as you can see. So I'm not too quite sure what the analysts are thinking, but I'm thinking that this stock is maybe a little too overpriced. The growth has been good for the company. They've grown their sales, year over year, especially in 23, they saw good growth of 20%. But when we look at the quarterly is coming down to 7.76%. My view of, the data center growth is that most definitely the data center is growing, and we're going to see this infrastructure really get built out in the data center. But these are infrastructure build outs. They're not reoccurring revenue streams. They're like construction projects. When you build a building and you get done, that's it. It's not like the customer wants you to build a new building every month or every year. They want you to build a building, and then you got to go find other properties to develop. To use an analogy outside this industry, in the case of the data center build out, it's similar to that. Once you build it out and that infrastructure gets utilized, you don't need infrastructure again for a while. It's cyclical. So you're beginning to see revenues drop for Vertiv, and it may be the signal that revenues are going to be lower, or I should say the growth rate on revenue is going to be lower. So I would expect that the growth rate is going to come down maybe to 10%, 5%. And then they're going to be just like any other hardware company. Hardware companies tend to grow by a modest amount and so forth. Their cash flow is positive for the current year. The last full year, they had $778 million of free cash flow, which is very good. But it hasn't been a consistent cash flow. If you look at the cash flow over the last 5 years, it's not like we have an upward slope, which is something I like to see. It's somewhat been all over the place, negative values, and then really having a spike in the most current year. When we look at the the quarterly for free cash flow, the free cash flow is dipping a bit, so it's not going to keep up with that really high rate of 700%. But we'll see. We'll see how their cash flows go. They are in a boom cycle, but I would not completely feel like I could forecast those cash flows to have a nice smooth upward slope to the right. It's really I think it's a boom period now that is going to be cyclical. They're going to have probably a tougher year next year and in 2026. 10 analysts cover this company, and the forecast for the company and the price prediction for their stock price is all over the place. We have, some analysts are saying the stock is way overpriced, $41 price target from one analyst. And the best price target isn't overly, ambitious. It's just slightly above the current stock price. So, the current rise of the stock has really been incredible, and analysts are not, betting too much of their credibility on this company. The average is 89. It's just slightly above their current price. So overall, it's good to see analysts are putting opinions out there, and I'll compare my final opinion against these to see if I'm kind of matching up with one or two of these analysts. Earnings per share for the current year look really good, but the forecast that analysts have, I can't believe in, and I'll have some comments toward the end of this clip here. So the current, earnings per share for the current year is expected to be $2.41, which is much higher than the previous year. So you can see that they're really profitable in the current year. It's expected that they're going to keep growing those earnings per share, and I just cannot buy into that forecast. This is a cyclical industry, and I expect that especially in 26, they may have a hard time making money. And you can see that in their history. They had a hard time making money in 22. They lost money in 2019 and in 2020. So you're seeing the cyclical nature of this particular industry. So this forecast is a little too optimistic for my book. And I am comfortable with the expectation that they're going to have a solid 2024. But as we look at 2025 and 2026, I think it's going to be a little tougher for this company. So just a quick scorecard on the company. Again, I really focus on the company if I think the company is really worth having. It just is really valuable. And I come back to the most valuable companies on the stock market. They just really have desirable traits, or they have barriers of entry to competitors. They have a brand that's really valuable. Their customers will be very loyal for a long time. When it comes to this company, the strength of their moat, or the strength of their barriers of entry, I think their moat is actually a narrow moat, not very wide, and it has low strength. And the reason for it is that this company could compete against Hewlett Packard Enterprise, Dell. There's a lot of competitors, and these are global competitors. So you see competition out of Asia. So I just don't have a lot of value in that area. They're a high risk company. Their return on invested capital has been really good. They've had a great year, and they don't have to put a ton of capital into their supply chain. Their earnings yield has been terrible. Earnings yield of 2.4%. You can make 5% on your cash right now. So your earnings yield on this company is 2.4%, not even keeping up with a cash yield. And their free cash flow yield, again, is really terrible at 2.5%. And that's with one of their better years, using that number and comparing it to their current stock price and market cap. So from a earnings yield and free cash flow yield perspective, just an undesirable investment. I created my own valuation for Vertiv using discounted free cash flows and also using their earnings per share to arrive at a value that I think the company is worth. And here's my conclusion on that. Using their cash flows and really giving them the benefit of the doubt that they're going to keep those cash flows and actually grow them in the current year. And I expect that they could probably do $854 million of free cash this year. Again, giving them the benefit of the doubt and saying they're going to grow those cash flows over the next 4 years, and they're going to grow them by 10%. And then anything after year 4, it's going to grow at 3%. This is a very optimistic forecast, in my opinion. I'm going to discount the company by 11%, which is a higher discount rate that I'm going to use against these cash flows because they are a smaller company, and I believe they're in a risky space. And the intrinsic value of all those free cash flows is $11.7 billion. I added the cash on the balance sheet and took away debt. And when I get to an equity value of $8.9 billion, the current market cap is way up at $33.5 billion. A current stock price of $90.62 is way overpriced to the order of 74%. So the stock is 74% higher than the value of their free cash flows. That's pretty interesting. Looking at their earnings per share, I'm using my own earnings per share number, not necessarily what the market's using. I think the market's using a number that's too ambitious. I'm giving them the best PE I can give a hardware company, which is 18. These guys are not NVIDIA. These guys are not a company that holds the intellectual property. They're just creating hardware. And the growth rate on that, on the earnings per share, is going to be 4%. It gives them a value per share of $40, but the stock price is 90. So it is overpriced by 55% because the earnings per share expectation of the company optimistically is going to be about $40 per share, but the stock price is way higher at $90 per share. So it's 55% overvalued. I blend the two, putting more weight on free cash flow, and it's 68% premium on this hardware company. So what's the best investing play for me at Vertiv? As mentioned, it's really hard right now to find companies that are discounted in technology, especially anywhere near the data center that is aligned with AI. In this case here, there's some things that I don't like about the company, and to the point where I think I'm going to be shorting this stock. Let me take you through that decision. So first, around the business, do I like buying hardware companies? The answer is no. And the reason for it is they tend to have just modest gains, modest everything. And at times they have really bad years. I think Vertex is enjoying a really good period in time, but it's going to be a one-time event where data centers are really going to build out. New competition is going to come in and probably compete against Vertiv in the category of products that they have. So with regard to the company, I think there's better choices for me to invest in, and I don't like the company. The balance sheet is fine. The company is on solid ground, so I don't have an opinion on their balance sheet. But when it comes to the price of the stock, it is so overpriced that it presents an opportunity to short this stock. Now, shorting a stock is really risky. So I'm going to go into a short position with Vertiv and grow it over time. I'm going to start about $1,000 position and then grow it each week if I see fit. We'll see where the stock goes. But my expectation is that we're going to be seeing a stock that's going to be worth quite a bit less in about a year's time. We'll see how much longer this AI hype continues. Each week, I continue to see more people talk about the AI bubble. More people begin to really question if a lot of these stocks are overbought and way overpriced. People online, for example, Jim Cramer is recommending that people take profits. He's been one of the biggest advocates for AI for some time. And if one of those guys is saying it's time to take profits, boy, it is really time to sell, I would think. But, the investors of Vertiv are probably sitting on great gains. So congratulations to anybody who's been an investor in Vertiv, and you'll need to make a decision on when to sell. Or if you want to hold, that's your prerogative. So that's my opinion on this company. Again, I don't recommend that you buy, hold, sell, or short this stock. It is just my individual journey as an investor, and I hope you found it interesting. Thank you for watching.